Something happened in the silver market that most people will describe as a price story. It isn't. A level that was treated like a ceiling just got punctured, not with a gentle tap, with force. And when a market breaks a ceiling that the system has defended for years, the question is never, how high can it go? The question is, what failed? I'm not here to celebrate a number. I'm here because I study patterns. And this pattern has shown up before, in different costumes, with the same skeleton underneath. In 1980, when silver turned into a headline, the system didn't respond with honesty. It responded with control. Not emotional control, structural control, rule changes, constraint. A sudden tightening that rewrote what normal trading meant. In 2011, when silver climbed back into the spotlight, the story ended the same way. Pressure builds, then the guardrails get moved. The market doesn't collapse because reality disappears. It collapses because the plumbing gets adjusted, and in the modern era, you've seen this outside metals too. In moments of stress, institutions don't denounce danger. They manage it, quietly. Through liquidity, margin, access, and conditions, the public sees the surface, the system works in the pipes. So when silver pushes into a new zone, and the usual dampeners don't immediately stop it, that is not bullish vibes. It is a signal that the balance between paper promises and physical demand is shifting. You don't need to believe any heroic story about good guys and bad guys. The markets don't run on morality. They run on incentives, shortages, and trust. When trust is high, paper is easy. When trust gets questioned, paper becomes negotiation and physical becomes certainty. And here is the detail that matters if you, or a man trying to protect a household, not win an argument online. Big financial events rarely arrive with sirens. They arrive as small mechanical failures that the average person doesn't T-track because he is busy living. Mortgage, retirement accounts, kids, work, time. That's exactly why these patterns work. They don't need you to panic. They only need you to stay distracted. Today's number is loud. The real message is quieter. The system just showed you a seam. Now the question becomes, when a seam appears, what do the people inside the system do next to keep it from becoming a tear? Because the next move is usually not a price move. It's a rule move. And that's where most people realize, too late, that they were watching the wrong thing. Most people believe markets move because of news. They don't. They move because of pressure inside the structure. Think of the silver market not as a chart, but as a machine. When everything is calm, the machine runs on trust. Contracts are just promises, and promises are enough because no one is asking too many questions at the same time. That's the invisible mechanism. As long as confidence is high, paper behaves like metal. Futures, ETFs, forwards, warehouse receipts, they are all treated as if they are the thing itself. Nobody insists on touching the object because the system has taught them that delivery is theoretical. But this machine has one weakness. It only works when demand is passive. The moment demand stops being, I want exposure, and becomes, I want possession, the gears start to grind. This is where most people get it wrong. They see price spikes and think speculation. They see pullbacks and think exhaustion. But the real signal is not the price. It is the behavior of the largest participants. When institutions quietly shift from trading promises to securing supply, they are not chasing upside. They are managing risk they don't want to talk about. We'll come back to that. For decades, silver lived in a world where supply responded slowly and demand was easy to postpone. If price went up, buyers waited. If inventories thinned, paper substitutes filled the gap. The system could stretch because it wasn't being asked to deliver, only to perform. That balance is now changing. Industrial consumption is no longer a background variable. Energy infrastructure, electrification, data processing, these are not lifestyle choices. They are structural commitments. Once factories are built, once grids are upgraded, once production lines are configured, the metal is no longer optional. It becomes a dependency. This matters more than it looks. Because paper markets are designed for liquidity, not dependency. They assume that at any given moment, only a fraction of holders will ever demand the underlying asset. That assumption is the oxygen of the system. Remove it, and everything else suffocates. You don't need a shortage to stress a market. You only need a mismatch in expectations. When producers plan based on physical necessity and financial systems, plan based on statistical delivery, you get a quiet conflict that never shows up in headlines. It only shows up in behavior. Who is willing to wait? Who's no longer willing to roll? Who starts to think in terms of just in case? That is the invisible mechanism at work. And once you see it, price movements stop being stories about excitement. They become footprints. The footprint we just saw tells us one thing. The machine is being asked to do something it was not designed to do. We're going to trace exactly how that same mistake has played out before, and why the ending is always structurally similar, even when the surface looks different. The first time this pattern showed its teeth, the surface story was excitement. Underneath, it was stress. At the end of the 1970s, silver stopped behaving like a commodity and started behaving like a referendum on trust. Inflation was high, confidence in paper money was thin, and large pools of capital began moving from abstract promises into things that could not be printed. At first, it looked like a rally, then it looked like mania. What almost no one was watching was the infrastructure, delivery rules, margin structures, settlement terms. The quiet plumbing of the market was being forced to accommodate behavior it was never meant to host. And when that plumbing couldn't keep up, the response was not a shortage headline. It was a rule change. Trading conditions were rewritten midstream. Requirements were raised. Access was narrowed. So the market did not discover a fair price. It was steered away from one. This is where most people get the lesson wrong. They remember the chart. They forget the mechanism. A second rhyme appeared decades later when silver clawed its way back into relevance. Again, the story was framed as speculation. Again, attention was glued to the price. But behind the scenes, the same sequence was unfolding. Rising interest in possession collided with a system optimized for turnover. The pressure didn't break the metal market. It bent the operating environment. Margins went up. Conditions tightened. The machine defended itself not with supply, but with structure. And again, it wasn't presented as a crisis. It was presented as prudence. The third case is less famous because it didn't live in a single headline. It unfolded in slow motion across multiple asset classes whenever liquidity thinned and participants stopped trusting that tomorrow would look like yesterday. Banks didn't announce danger. They adjusted access. Exchanges didn't declare failure. They modified behavior through technicalities. Every time the pattern appears, it carries the same DNA. A long period where paper is enough, a quiet migration toward physical or direct control. A stress point where the system is asked to honor more promises than it comfortably can. And then, instead of transparency, an administrative response. This is not drama, it is muscle memory. Markets do not like admitting fragility. So when the load gets heavy, they don't shout. They recalibrate the rules of the game so that the weight feels lighter inside the building, even if it's crushing on the outside. If you only look at price history, all you see are spikes and crashes. If you look at structure, you see something more unsettling. The same question asked over and over again by the same institutions, in different decades, wearing different logos. How do we maintain order when confidence turns into demand? Because that is the real test, not whether something becomes popular, but whether the system was built to survive being believed too literally. And that question is not finished with us yet. Most people think the present is unique. It isn't. The same mechanism that strained the system in those earlier episodes is now visible again, but in a form that looks cleaner, more modern, more sophisticated. That appearance is part of the camouflage. Start with timing. You don't see structural stress at the bottom of a cycle. You see it late, after years of accommodation, when liquidity has been abundant and behavior has been conditioned to expect rescue. That is when markets stop pricing risk and start assuming continuity. Now look at scale. The silver market is no longer a niche for collectors and speculators. It is embedded in the infrastructure of energy transition, electrification, and digital expansion. When an input becomes foundational to multiple growth agendas at the same time, the system cannot respond with the usual playbook of substitution and delay. Then consider institutional behavior. This is the part that rarely gets airtime. Large players do not signal stress by making speeches. They signal it by changing how they source, store, and prioritize control. They move from efficiency to resilience, from optimizing yield to minimizing dependency. This is where most people get it wrong. They wait for someone to say the word crisis. But in complex systems, that word is never spoken until after the response is already underway. The early phase is invisible. It looks like logistics. It looks like inventory management. It looks like normal operations. But if you study patterns, it doesn't look normal at all. What we are watching today is a convergence of three pressures that historically do not coexist peacefully. First, physical necessity. Industrial demand is no longer discretionary. When factories, grids, and data infrastructure are configured around a material, they don't negotiate with price. They negotiate with availability. Second, financial abstraction. Decades of financial engineering have created layers of claims on top of a limited physical base. This works beautifully until too many people want the base at the same time. Third, administrative reflex. When the first two collide, institutions do not default to honesty, they default to management, not price discovery, condition discovery. This is not a forecast. It is a mirror. The surface story is a number on a screen. The structural story is that the machine is now carrying a load it has historically chosen to deflect rather than absorb. And here's the detail that should matter to a man balancing retirement, career, and family responsibilities. You are not exposed to the future because of what you believe. You're exposed because of how the system behaves when belief changes. That is the point of studying patterns, not to predict tomorrow, but to recognize when today starts to rhyme too closely with chapters that never ended well. We're going to pause here for a moment because the next piece explains why the majority never sees the danger until the window is already narrowing. There's a reason the majority always misses this phase. It isn't ignorance, it's adaptation. When you live inside a system for long enough, you stop noticing its edges. You plan your life around assumptions that have worked for decades, that your savings will be accessible, that your statements reflect reality, that institutions exist to stabilize, not to ration. None of that is foolish, it is functional. But it creates a blind spot. Men in their late 30s and 40s don't have the luxury of obsession. They're building careers, raising children, servicing long-term obligations. Their attention is calibrated for continuity, not rupture. And because the system has rewarded that mindset for most of their adult lives, it feels natural to believe that any disruption will arrive with notice. This is where most people get it wrong. They look for headlines when they should be watching behavior. They wait for announcements when the real signals are procedural. A change in access, a shift in settlement norms, a subtle tightening that is framed as housekeeping. This matters more than it looks, because large transitions are rarely introduced as events. They are introduced as adjustments. They are marketed as improvements. They are described as necessary for stability. By the time the public is invited into the conversation, the architecture has already moved. There's also a deeper psychological layer at work. Humans are wired to anchor to the present. We interpret continuity as safety and novelty as noise. That bias is invisible when conditions are stable. It becomes dangerous when conditions are changing quietly, so most men will continue to do what has always worked. They will focus on income, contributions, long-term plans. They will glance at markets, note volatility, and move on. That behavior is rational in a world that rewards patience. But systems do not fail on human schedules. They fail when structural limits are reached, regardless of who is busy living inside them. That is why this phase never feels like the beginning of something. It feels like background turbulence, a little noise in the machine, something to ignore, until it isn't. And that is where the final shift always accelerates, because once enough people realize the environment has changed, the calendar compresses. What once unfolded over years begins to unfold in months. We are entering that window now, not in the sense of a date, in the sense of a tempo change. And tempo, once it shifts, does not ask for permission. When a system moves from stability to stress, the calendar changes. At first, everything still feels slow. Reports come out, committees meet, analysts argue. From the outside, it looks like the same machine it has always been. But inside, something has already flipped. This is the acceleration window. It doesn't begin with a crash, it begins with behavior. Participants stop optimizing for efficiency and start optimizing for certainty. They shorten horizons. They pull decisions forward. They accept friction they would have rejected a year earlier. This is where most people misread the moment. They assume time is still measured in quarters and years. But in late cycle environments, time compresses. History shows this repeatedly. Once confidence thins, processes that once took years are resolved in months, then weeks. Not because anyone wants chaos, because systems under load do not scale linearly. They snap from one operating mode to another. Here is the uncomfortable part. During this phase, the most visible moves are not price moves. They are administrative moves. Requirements tighten. Access changes. Settlement conditions evolve. All of it is described as maintenance. This is where we'll come back to the invisible mechanism we discussed earlier. Paper systems are built on the assumption that not everyone will want certainty at the same time. When that assumption weakens, the system does not advertise the problem. It manages it. It introduces friction in places the public doesn't immediately recognize. Margins are not raised because something is wrong. They are raised because the machine is protecting itself. Delivery terms are not adjusted because supply vanished. They are adjusted because too many people are behaving as if supply might vanish. From the outside, this looks technical. From the inside, it is existential. And this is why the final phase always feels sudden. Not because nothing was happening before, but because the tempo had already shifted while most people were still counting in years. We don't need a date to understand this. We only need the pattern. The pattern says that once a market enters this window, the distance between recognition and response collapses. That is when rules change faster than beliefs. And in that environment, the men who feel blindsided are not the ones who ignored the news. They are the ones who trusted the calendar. Now there's only one piece left to understand. Why this never ends with a warning, only with a realization that the window is already closing. There is no siren for this phase. History doesn't raise its voice when systems reach their limits. It lowers it. By the time the public is invited into the story, the framework has already changed. What used to be assumed is now conditional. What used to be automatic is now reviewed. And what used to be liquid is now managed. This is the quiet warning. It is not a call to act. It is a call to notice. Every major financial reset in the modern era shared this feature. The last stage was never announced as a turning point. It was introduced as policy maintenance, market stability, procedural necessity. The language was calm. The impact was not. If you're trying to protect a family rather than chase a trade, this distinction is everything. Loud crises invite reaction. Quiet transitions punish inattention. And this is where the discipline of pattern study becomes practical. You do not need to know what will happen next. You only need to recognize when the environment has stopped behaving like the one that shaped your plans. When the system moves from trust to management, the risk profile changes even if the headlines do not. That is not pessimism, it is literacy. And here is the part that never fits into a news cycle. The most dangerous moment is not when fear is visible. It is when calm is still plausible but conditional, when statements still arrive on time but access begins to require justification, when systems still function but only under revised terms. That is when the future stops being theoretical. This is not a reason to panic. It is a reason to pay attention to the right layer of reality, not the screen, the structure behind the screen, because history does not repeat itself with explosions. It repeats itself with edits, and the final edit is rarely the one people expect. What we have been tracing is only one half of a larger pattern. It connects directly to another cycle that most observers study in isolation, even though the two have always moved together. That connection is where the next conversation begins.